Hey everybody, and welcome to Looking at the Markets with David Modell. Buying options before earnings or some other big event. Should you do it? Well, I'm telling you right now that I choose not to do that usually. There are exceptions to everything, but I recommend for most people in most situations, don't do it. There is a better way. I'm going to tell you why. 8 out of 10 times, 80% of the time, options are overpriced. Puts and calls are overpriced. They cost more than they should compared to the actual move of the stock or whatever the underlying asset is. It could be an ETF or whatever, but I'll just say stock from now on. Compared to how far the stock actually moves, the put or the call is overpriced. It's too expensive 80% of the time. That's generally. Okay, now what about right before earnings or some other big event? It's probably more than 80% of the time overpriced. It's probably more like 90 or 95 or maybe even 99% of the time. Okay, maybe not 99, but probably more than 80% of the time it's overpriced. Why is that? Because especially if there's a really hyped up earnings announcement or other event, then people get really excited and they overshoot in terms of their expectations of how far the price is going to move after the earnings announcement or other event. And so the options pricing model, which you're looking at right now, it's called the Black-Scholes model or Black-Scholes formula. It prices in the expectation of how far the stock is going to move. And that includes IV or implied volatility. And it includes other factors. It also includes theta decay or time decay, which is going to work against you if you buy a call or a put. But also there's probably, after the earnings announcement or other event passes, there's probably going to be what's called IV crush or IV collapse, meaning that all the excitement, it's like the air being let out of a tire. Okay, they pump up or inflate the price of the option, the put or the call right before the announcement or event, and then the tire, the air gets let out. Okay, the price of the option tends to go down at least somewhat, unless there's a really huge move bigger than what was expected. But the expectations are so huge because there's so much hype and hoopla that it's really hard, to get a move as big as what was expected. Excuse me. So, what's a better way? Well, how about waiting until after the announcement or event, and wait until afterwards, and then wait 3 or more trading days? Excuse me, my voice. You wait maybe 3 or more trading days. That's the 3-day waiting rule. Which means after a big move, a big red candle or a big green candle, you might want to wait at least 3 trading days to see if it's a big red candle. Oftentimes, within the first couple of trading days after the big event, if there's a big red candle, then oftentimes there is a medium-sized red candle after that, and then a small red candle after that. Okay, it tends to go in the same direction. And if there's a big green candle, you might expect a medium-sized green candle after that and then a smaller green candle. Not always, okay, not every time, but this tends to happen oftentimes. And so you don't have to buy necessarily right after the big red candle or go short right after the big green candle. How about waiting a few trading days, okay? And this is all after the earnings announcement. And that way, if you're buying a put or call, at least you're buying it probably at a reduced price because the air has been let out of the tire. Okay, you look at that Black-Scholes model, and it's pricing in all the hoopla and excitement before the event, and then it lowers the price after the event unless there's some really huge move. All right. And even if there is a really huge move, still the IV level can still be reduced oftentimes. And since time has passed, now theta decay has set in. And that's in the Black-Scholes model that you're looking at right now as well. So I believe that's a better way to play it. Or, you know what else you can do? You can also buy stock instead of options if you're into that. Because the IV and the theta decay, that is not priced into stock. Okay, now the hype and the hoopla might be priced into the stock. Oftentimes it is, the stock shares. But at least you're not dealing with You're not dealing with the IV crush or the IV collapse. You're not dealing with theta decay when you buy the stock. Okay, what you can do is maybe buy 100 shares of stock and then sell a covered call. So at least you're a stock buyer and an option salesman. And so if the IV crush or IV collapse sets in, then that will lower the price of the covered call that you already sold before the event. Okay, or you know what, you don't have to buy anything at all before the big event. Okay, just wait until afterwards. Not a bad way to go. What some people do is they sell options or option spreads before the event, because if these options are overpriced 80% of the time, then you could put the odds on your side and sell options. Just be really careful. I do not recommend selling uncovered options, an uncovered call or an uncovered put, selling that right before a big event. I do not recommend that at all, because you can lose a lot of money if there is a huge move, which does happen on occasion. The stock could move 20 or 30% or more. I've seen that. So, but if you sell something that's covered, maybe a spread, really carefully, then you could have that 80%, overpriced rate of options working for you instead of against you. So that's another possibility. Just be really careful with selling options, because you can lose a lot of money. But if you do it correctly, the probabilities can really be on your side. They can be working for you instead of against you. But what my main play, my bread and butter, is to wait until a stock or whatever it is goes down a lot after a bad earnings event, especially if that earnings event is just based on nothing more than analysts' expectations being too high. All right. So if that's the only reason the stock went down a lot, then I have a tendency to want to wait 3 trading days at least, and then maybe consider getting in if the bleeding has slowed down and stopped and the stock is going sideways or starting to curl up a little bit. That's even better. All right, so I hope I give you some perspective. I hope my voice held up reasonably well. And listen, if you appreciate this video, why don't you give me a thumbs up right now and subscribe to my channel if you haven't done it already. Go ahead and subscribe right now and hit that notification bell on YouTube so you'll be notified whenever I put out more videos like this. And if you want some coaching on options or stocks, trading or investing, you can email me anytime at davidmodell@gmail.com. It's on your screen right now. Thanks a lot. I really appreciate it. I'll talk to you again soon.